Let's discuss about this session conceptual framework of accounting. I am Madan Kumar, Assistant Professor of PG and Research Department of Commerce, CPA College, Odinayakanu. Introduction of conceptual framework of accounting. Accounting is a knowledge of business. It records business transaction taking place during the accounting period. Accounting communicates the result of a business transaction in the form of final accounts. With a view to make a accounting result understood in the same sense by all interested parties, certain accounting assumptions, concepts and principles have been developed over a course of a period. Then we are discuss about the important accounting concepts and conversions are discussed below. So first one is accounting entity concept. Accounting entity concept is owner and business are two different entities. The concept denotes that a business unit is separated and distance from the owners. So therefore it is necessary to record the business transaction separately to distinguish from the owner's personal transaction. This concept has now been extended to the accounting for various division of a firm in order to ascertain the results of each division. Then second concept, dual aspect concept. Every transaction has two aspects. One is debit aspects and another one is credit aspects. Each transaction have two aspects. So if a business has accrued and assets, the assets which comes in this one aspects. To accrue the assets, the business has to pay money which goes out. This is another aspect. Then money measurement concept. Only monetary transactions are recorded. So which means accounting record only those transactions which are expressed in terms of money. The use of building and the use of services can be added up only through money value and not otherwise. Periodic concept. So accounts are closed at the end of the accounting period. So it is generally 1 year. A business is assumed to continue infinitely in order to ascertain the state of affairs of the business at different intervals. So we have to choose the interval for ascertain the financial position and the operational result at each such intervals, which is known as accounting period. Usually a period of 12 weeks or 360 days is considered as the accounting period when bookkeeping. Any accounts take the bookkeeping. Then going concern concept, a business will continue for a business. So it is assumed that the business will exist for a long term or and transaction transactions are recorded from this point of view, that people may comes and go, but business remains. That's all. Then his principle is of concept, hence prepare a classification of express expenses is to be made. Matching concept, express relating it to a particular period or to be matched with revenue related to that period. Cost concept, assets are recorded at a cost price. The transactions are entered in the books of accounts at the amount actually involved. For example, if a firm purchases a land from 2 lakh, but concerned it as worth of rupees 4 lakh, the purchase will be recorded at rupees 2 lakh and not at any more. This is one of the most important concept in accounting when bookkeeping also. Realization concept, revenue should be recorded only when it is realized. Accounting is a historical record of a transaction. It records what has happened. Usually money has been realized, either cash has been received or legal obligation to received from the customer. No sales can be said to have taken place and no profit can be said to have arisen. Object evidence concept, every transaction must have a supporting document when bookkeeping and also when maintain the books of accounts. Accrual concept, a transaction is recorded when it is entered into and not when settlement takes place. Conversion and conversion of consistency, accounting rule and practices should be continuously observed. The accounting practices should remain the same for all years to come. The rules and practices should not be changed from time to time and in between time. For example, the stock in trade must be valued on the basis of the same method in all the year. Then depreciation also, then calculate the like that. Then conversions of a fully disclosure. Yeah, accounting must disclose fully and fair informations. Apart from legal requirement, a good accounting practices also demand that all significant information should be disclosed. For example, a value of assets have to be stated along with the mode of valuation. Conversion of materialized, relativity importance and significant monetary items are to be recorded and disclosed in the financial statement. Conversion of conservation, well, recording a transaction for only the prospective losses and not the prospective income should be considered. Thank you.